In this series, we talked about the journey, we talked about the 10 steps, and at the end of this series, I'll give some recommendations. So really, the journey, it's made of milestones here, and ideally we want to get from the point where we are to a point where we are profitable and consistent. As you know, we'll need to change a few things, particularly behavior, routines, and most importantly, beliefs. Trading is not a job, in fact, it's a business, and trading as a business is also a fundamental part of my 7 pillars for trading in modern markets. My recommendation is to not just try to make some money quick bucks, but rather learn skills that will serve you for your life. And the reason why 95% of traders never learn effective skills, the reason why 95% of traders lose consistently in the market is because they never learn effective skills. So these are the steps. Today we're going to cover number 3. But as you know, there are 10 steps, and number 3 is the mechanics of a valid trading edge. So let's look at what is a trading edge. Well, trading edge is no more than the method that you use to identify setups that you want to trade. Now, once we have identified the setups, of course, we need to have also a methodology to prove that the setups are indeed valid, meaning that there is actual the participation from smart money and from professionals that we anticipate in that area for us to take a position. And I believe every the system should have a confirmation process. Call it timing, call it filter. You can call it as you want, but it has to be something that gives a confirmation signal. Because as we now know very well, and you can review step 1. The market can do anything, and without a confirmation process or confirmation technique, we put ourselves at unnecessary risk. So we need a trading edge, a method with a positive expectancy. If you don't know the meaning of expectancy, I'm going to explain that in a minute. It's very simple concept, but very, very important concept. And so, as part of you becoming a successful trader, you will need to learn the mechanism of a robust trading method and develop a trading edge. This is usually the component people focus on the most. The problem is that it's likely that if you have been trading for a while, that you have actually stumbled upon a method that has a positive expectancy, that has actually shows a trading edge. The problem is that we as people sometimes don't let this method work because we are impatient, we don't follow simple plans, because we do not realize the statistical validity of methods that actually show their validity only on a relatively large number of trades. So it's one of the reasons a lot of people just focus on the method. They tell me, give me the rules or give me the signal, I'll take care of the rest. Really, this is only one of the 10 steps. So if you only have a good method and you don't have the psychology in place, you don't have money management, a number of other things, you will very difficult you'll be able to reach trading success. So it is relevant, but not necessarily the most important. And again, you probably stumbled again or used in the past a good method, maybe not a great method, but a good method that gives you a trading edge. However, the reason why you are probably not able to trade it is because you have not developed the confidence and discipline to use it to generate consistent result. And this is very important, the key in consistent trading, in successful trading, rather. Now, when I speak about a model or trading edge, we're really talking about the mechanics of trading, how the market moves, how we identify the setup, how we identify the areas where we want to get involved. And using timing technique, like for example, FibStalker timing, we can look at whether we want to get involved. Okay, so identifying the technical edge kind of put together all these, but not only identify the areas or the setups, but it's also identified precisely what is the step-by-step, the procedure that we follow to time these entry areas. So one or more trading system to identify setups. This is what we need. The trading system is a set of rules that allows us to generate a trading plan. Sometimes people make confusion between trading system and trading plan. Trading plan is an output. A trading system, it's really the input rules. And when we put through these rules the price data, we get the outcome, which is a valid trading plan. It is very important that we understand how significant players are positioned in the market. I've talked about this a little bit lately, and as you know, I follow two, or try to track and represent also on prices, on charts, two significant players. The first group is the smart money. The second group is the dump money, and it is very important to kind of build a map, a mind map, if you wish, of how these players are positioned in all time frames. It is very, very important to successfully trade a setup. Of course, as part of the mechanics of trading or trading edge, you need a timing technique which tells us when to enter a valid setup. So the fact that we have a valid setup doesn't mean that that setup will be participated. And we don't know that until we test it, we prove it by applying a timing technique. I apply and use the FibStalker timing, which basically uses the same concept that I use to identify how algorithms are positioned on the larger time frame. It is applied on the smaller time frames, and as we know that algos even trade against one another on different time frames, we can use that mechanism for timing. Very effective timing as well. And the mechanical trading also includes a basic position sizing, so how much we wage, and I'm always surprised of how many people risk real money, also sensible amounts of money in the markets, and they don't even know the basic rules to actually position themselves in the right way to calculate the size of their position. And of course, as a result, when they don't do that, they don't know how much they are risking, which is very, very risky itself. In fact, in past step 2, we spoke about risk. It's not that the markets are inherently risky. The trader or the investor are risky, not the system or the market, because not understanding risk and not managing risk makes the whole game riskier. Again, the 7 pillars of trading in modern markets. When we speak about the mechanics of trading, we're really focusing on this part of the model here. We have the psychology of the market, the method, the timing, and a basic money management. Money management can be extended and expanded, and we're going to do that to prove how we can use money management to actually reach objectives in trading. All right, so how do we master a method? You need to learn basic but important trading metrics before you master a method in order to evaluate that method. And I mentioned the expectancy before. It's one of the key concepts here. And together with expectancy, we have reliability, which is really the number of winning trades divided by the total number of trades, and that's the percentage of winners, if you want. 1 minus the reliability give us the percentage of losers. Okay, so 1 minus reliability actually equals the percentage of losers compared to the percentage of winners, because anyway, winners plus losers, they have to be equal 1, which is 1%. Okay, sorry, 100%, of course. Expectancy, on the other hand, can be defined as the dollar gained in average for each dollar that is risked. Now, I'm not going to get in this quick webinar here into explaining how we go with the calculation expectancy. I've done that in a number, probably in a couple of webinars, and you can find them on FX Street. What is important to mention here is that this is a measure that actually tells us how many dollars we are doing for every dollar that we risk. And this measure expresses how good is our system. If you're making $2 for every dollar we risk on average on all trades, well, that's a very good system. If on the other end we are doing 20 cents for each dollar we risk, well, I wouldn't trade this system because what I make compared to what I risk, it's not. There's a big imbalance here. Okay, so normally we want something around 1 or bigger than 1. The bigger, the better, of course. Another important measure which is derived from the expectancy is the expecturity, which is really the expectancy times the number of opportunity in a specific period of time. In this case, I'm considering 1 month here. So obviously, the higher the expectancy, the better. The higher the frequency, which means the higher the number of opportunities or trades that satisfy that specific method, that specific trading edge are generated, the better we are in the long term, and the better we are trading this system. Okay, so very, very simple concept. Are an outstanding and incredible number of people do not know that their numbers do not know what they are really trading, and this is key. Trading is a business. You have to know these numbers. So performance improves when you start measuring. Someone said that it's very, very important. So not only these numbers help you really understand what you're trading, but they also help you understand how you're doing if you're trading a system with this measure, because you can measure your sequence of R multiples, which is the results that you get for your own trades, you can compare them with the figures and metrics and measures that are expressed here. All right. So the simple metrics above allow measuring the quality of a method, but as I mentioned before, they also allow you to measure your own trading, how you are performing, and so by measuring that, we can improve, because performance improves when you start measuring. So it's very, very important. So number 1, you need to know your method. Number 2, you need to know your performance. And when you know both, you can actually generate information that you can use to improve your trading. So the key of a good method is not really the high reliability, but high expectancy. I mean, we can have methods that win a lot, let's say 80% of the time, but they're very poor in their expectancy, while we might have systems that win only 50% of the time, and they can have an expectancy which is 1 or bigger. So remember this reliability, or how right you are, how frequently you are right. It's not the most important measure. The most important measure is always expectancy, and the higher expectancy, the better. So a trading edge, a method, can be described by this key concept or key measures here, which also explain and clearly in numbers that there can be losses if reliability is not 100%, as usually it is in every system. Then you need to learn to live with losses, which are a fact of trading. All right, so we look at those trading metrics. And I want to offer here some example of what this trading metric could look like, so you have an idea. Particularly, I'm applying this to the FibStalker method signals, and these are based on my experience on what you can expect in the long term, in average, from the use of FibStalker methods and signals. Now, the metrics here are provided for both full risk and risk-free. Again, I'm not going to explain what risk-free trading is, but if you go in my page, and if you go on FS you will find a very good and simple explanation of risk-free trading. Okay, the point is that when we use risk-free trading, we exit half of the position as soon as our gain, paper gain, equals our risk, and that's what I call a risk-free. I call risk-free trading, and that's what I call a risk-free position. And the advantage is that position then goes back and stops us out. We never move the stop. Then we end up at break-even plus cost of trading. So when you look at the FibStalker methods and when you use full risk on swing trades, that's the kind of reliability we have to anticipate 60% with an average of 2.5 unit of risk in gains. And whenever we lose around 1 R. Sometimes we can lose 1.1 unit of risk. And in terms of opportunity, which is that frequency I mentioned before, we are between 5 and 8 opportunities in average per month. Sometimes they can be higher. And this is following, the 30 major markets, including 4 futures and 26 forex pairs. Okay, and the futures are S&P A-mini future, the dollar index futures, and then the mini gold and mini silver. Here you can use the larger contract as well. Now, when it comes to risk-free, and and here the expectancy is a little bit higher than 1, with an opportunity of 7.15, around 7 units of risk per month. And the average number of opportunity would be between 6 and 7 here every month. Now, when we use the risk-free approach, the expectancy goes down because we exit some of the positions, half of the positions, and of those 40% of loser, now we will have 20% that will close at break-even, and at 20% that will close as losers. And because we use the risk-free approach, now our winner that never stops us out have a return which is less than 2.5. In fact, it's 1.75. It's risk-free return. So when we compute all this, we have an expectancy around 5.5, which is not bad. The expectancy is below 1. The good surprise, and really where a lot of unit of risk can be accumulated every month, is when we consider the risk-free using intraday timing. And when we look at that, we have something like this, 40, 30, 30 here, whereas we have a smaller number of winners, but the average return goes much higher. We have 30% of break-even and 30% of loser here, because we have very aggressive timing on the 15 minutes or 1 hour. Despite that, the expectancy is higher, 1.3, with an expectancy that can reach around 40, and also the reason is that. So the reason for this are basically there are 2 reasons for that. One is that the average gain of winners is higher, and the number of opportunities much higher. In fact, we have 30 opportunities in average. All right, so this is, to recap, how we consider our trading edge. We described what a trading edge is. Allows us to identify opportunities as well as timing. It's basic position sizing in it, and it's very important to apply and take those valid setup only after timing and confirmation, and before that, after we have analyzed the market. In the 7 pillars of trading in modern market model, we are in the upper right side of the model here. To master a method, first we have to understand it, and to understand it, we have to apply some measure. We looked at reliability, expectancy, frequency, and opportunity. And we know that with this measure, we can measure the method itself, but we can also measure ourselves. We can measure our performance. And only when we measure, we can start improving. And that's very, very important. A key for a good method is not high reliability, but rather expectancy. And we know that there's no method that offers 100% reliability. Finally, we looked at some of the performance that you can reach with the FibStalker method. So if you want to get more information about the FibStalker methods, reach me out, and I'll be starting a new session of the FibStalker methods coaching program in February. So if you want to get involved, let me know. Drop me an email. And this concludes the step 3 of the 10th step to successful trading. Thanks for watching.